Hi, I'm Najib Khan. I'm a financial advisor by trade. I've been in the industry for well over 15 years, and today I'm going to be introducing you to saving for retirement and why it's so important to do so. One of the ways that a lot of folks save for retirement is through an employer plan. So typically what happens is when you join a company, depending on your company, they may offer you a employee retirement plan. Those employee retirement plans are typically 401ks. If you work in a public sector, say healthcare, or you're a school teacher, or you're a police officer, or a firefighter, you might have a 403b. Now you might be wondering, what are those numbers and letters that are following? Those are actually sections of the IRS tax code. Private employers typically have 401k plans, and for public employers, they typically have 403bs. They're effectively retirement account savings vessels, and when you participate in the plan, you have the ability to make sure that you're putting away money for retirement. Now, you're a young individual, you might be wondering, why is it important to save for retirement? The really big key part about saving for retirement is the sooner you can get started, the better off retirement will be in the long run. So typically what happens is your employer gives you the opportunity to save pre-tax or post-tax. So pre-tax is before you get your paycheck, there's gross pay. And in that gross pay, your employer takes out a portion of your money and they set it aside in your retirement plan, so your 401k or 403b. And so that is set aside. Some employers will match what you put in to a certain dollar amount. Some employers will match a percentage. Some employers will match maybe 50 cents on the dollar. Some employers will match dollar for dollar. Some employers will match a certain percentage. Some employers don't match at all. So it might just be you putting money away in your retirement plan for yourself. And typically those retirement plans are managed separately by a professional fund manager or plan administrator. Inside of your 401k plans, you typically have the ability to pick and choose mutual funds, other types of investments to invest into. Those 401k plans are professionally managed by a team of financial advisors that oversee that plan. So if you have questions about the plan, where do I put my money? How do I invest it? What percentage should I put in? There's a financial advisor that you can speak with on that plan directly to answer those questions. So when you participate in the 401k plan, typically what happens is every time you're paid, they take a percentage of your pay or a dollar amount of your pay and set it aside for you. That's invested for you, that keeps growing for you over time. One of the big things that is important for someone your age is compound interest, right? Compound growth. And the more you can set aside now, the larger that compounding effect will happen over time. And so what I tell most anybody that I speak with regarding retirement plans is if you're able to set aside as much as possible without constraining your regular cash flow, your regular budget monthly, then do so. Because when you first start, it doesn't seem like a lot. It seems like a very tepid amount, a very small amount to get started with. But as time goes on, you continue to grow that more and more and more and more. And with retirement plans that are offered through your employer, again, they're professionally managed. So you have a team of asset managers that helps you manage that plan. You have a financial advisor associated with that plan so you can ask them questions if necessary. And what's really great about 401k plans too as well is if you needed to borrow money for some reason, you could take a loan on the plan that's dependent upon your actual 401k plan. Some plan providers allow that, some plan providers don't, but typically that is a plan option that you can look at for yourself. And what that means is essentially, let's say you have $50,000 in your 401k plan and you need to take $5,000 out. You can take out $5,000 as a loan, but you pay it back through payroll deduction. So every pay period, they deduct a little bit of your pay to pay back the loan, and you don't have to pay it separately. It's very, very easy, very, very efficient, and interest rates tend to be pretty comparable to what's out there in the marketplace, but typically better than getting a personal loan or an unsecured loan of sorts. So when it comes to retirement plans through your employer, my one piece of feedback to any employee is get started as soon as you can. The more that you can put aside, the better off that you'll be in the long run. Earlier, we talked about the 401k plans and employer plans that are offered to you. So now you've graduated high school and you're looking for your first job. You find an employer that gives you a full-time job that pays you about $30,000 a year, and you decide that you're going to put aside 5% of your pay, and you've said, I'm going to dedicate this money to my employer-sponsored plan and put that aside, that equates to about $1,500 a year in savings from you personally. That's, if you divide that over the course of 12 months, a little over $100 a month is what you're putting away. Maybe a little over $50 per pay period is what you're putting away. $50 per pay period might seem like a lot, but as you start putting that away, it continues to grow for you over time because of compound growth. But let's also decide that your employer is going to match you 5%. Now they're giving you another $1,500. Now in total, you've got about $3,000 each year going into your retirement plan. Let's assume that you're 18 years old, and every year for the next 40 plus years, you put away $3,000 per year from 18 to the age of 65. You will have put in over $120,000 between you and your employer. But now let's add one extra caveat. Let's assume over that 40-year span that your money grows an average of 5% a year, right? From the time of 18 to 65, you've done nothing different. You're still being paid $30,000 a year every year for that 40 plus years. You're putting away 5%, your employer is giving you 5%, and nothing has changed. Just that 5% compounded growth in return is going to net you over $500,000 in retirement savings. Now you might be wondering, well, I only put away a little over $120,000. How did my $120,000 turn into $500,000? Well, if you think about the average rate of return of 5%, if we can take that 5% number and continue to compound and grow that number, that's what kind of catapults you over that $500,000 mark. And so when you're 65 years old, now you've got over $500,000 to work with when you're ready to take income from that 401k savings that you put aside. Typically, a lot of folks that put aside money in 401k plans are doing it because they want to have some sort of income source, and they're setting aside that income over the course of their entire career, and then when they're ready to retire, they're ready to take that money out of their retirement plan to supplement their income when they're no longer working. So with 401k plans, what you typically find is a plan that's offering you a menu of different mutual funds that you can pick from. So when you go into the 401k plan, there's typically a whole host of different investment options that you can pick from. If you're unsure, my recommendation is always to speak with a financial advisor that's on that plan, right? That way you're set up to make sure that you have everything that's specific to you and it's dedicated for your needs specifically. The 401k plan itself, when you've contributed to it, there are times where you'll switch jobs. So one thing to keep in mind with 401k plans is your 401k plan does not travel with you from job to job. So let's assume that you started, employer one, and you put away money in a 401k plan, and then you decide to leave that employer and go to another employer. That old plan that you left behind doesn't come with you. It stays right where it is. And it typically, a lot of folks forget about it because they maybe participated in a short period of time, or they maybe participated in a small window of time, but that money's left behind. So what you can think about doing is a couple options. With that 401k plan that you left behind, you can either roll it over into a IRA, or you can roll it over into your new employer's 401k plan. Typically, most folks roll it over into an IRA, and we can talk more about the benefits of an IRA and what an IRA is. So let's recap. So with 401k plans, who are they offered by? Typically offered by your employer. Your employer offers you either a 401k plan or a 403b plan, depending upon what sector of the economy you work in. If you work in the private sector, you're going to have a 401k plan. If you work in the public sector, you're going to have a 403b plan. Again, for 401ks and 403bs, you can participate as the employee. Typically, you're putting away a percentage or a dollar amount of your income into it, either pre-tax or post-tax. And then your employer may or may not match what you put into that. It's not guaranteed that they'll match you, but typically they do. Your 401k plan and your 403b plan also has investment options within them. So you typically can pick and choose the investments that are inside of them. If you're not comfortable doing so, my recommendation is to speak with a financial advisor that's on that plan for you. With the 401k plan, I provided an earlier example of if you can put aside 5% of your pay and your employer matches you 5% and the value of compounding growth. that example provided you the idea that if you put away that money over the course from the time of 18 to 65, you would have put in a little over $120,000. But with that 5% growth, it would have amounted to more than $500,000 in growth. We also talked about 401k loans briefly. You can take out loans if necessary from the 401k plan, and you can take out that loan and it would be paid back through payroll deduction. And 401k plans, again, the last thing I talked about was if you left that employer and you moved to a new employer, you have the ability to roll it over into an IRA, or you have the ability to roll it over into your new employer's 401k plan, assuming your new employer offers you one. So earlier in the 401k discussion, we talked about rolling funds into an IRA. Let's talk about what an IRA is. An IRA stands for Individual Retirement Account. There's typically two types of IRAs that most individuals will deal with. One is the traditional IRA, and the other one is the Roth IRA. So let's talk about the traditional IRA for just a moment. The traditional IRA is effectively a vehicle or a vessel where you can put money into and get a tax break. So there are situations where individuals say, hey, I've made too much money this year. The federal government and the state government is going to tax me. I need to reduce my taxable income. So with that, the IRA, the traditional IRA specifically, allows you to contribute money in to the plan, and that contribution is a reduction on your taxable income. So let's use an example. Let's assume that you made $50,000 this year, and then you owed money to the federal government because you didn't withhold enough taxes throughout the year for payroll purposes. You can establish a traditional IRA, and let's say you put in $5,000 into your traditional IRA. So what does that mean? What that means is you can subtract that $5,000 from the $50,000. Now your new taxable income is $45,000. By doing so, that may reduce your taxable liability when it comes to federal and state taxes. My recommendation with any type of tax question or anything like that is always to speak with a tax professional, whether it's a CPA, somebody who handles taxes specifically, because they can walk you through the nuances of that piece of it. With traditional IRAs, your contributions that you make into it, as I mentioned, give you a tax break. However, as you make those contributions over the course of your lifetime, at some point when you go to withdraw those, that's called a distribution. When you take a distribution out of your IRA, when it comes to a traditional IRA, you're going to pay federal and state taxes out of that IRA for that distribution. Now, that federal and state taxes, you can withhold taxes as part of the distribution. Let's use an example. Let's assume that you have $100,000 in your IRA and you take out $10,000. On that $10,000, you can withhold federal and state taxes. So if you withheld taxes, say 10% for federal and nothing for state, then you would get $9,000, right? Because 10% of 10,000 is 1,000. So you would subtract that $1,000, which means that went towards federal taxes. And so when you take distributions out of an IRA, the key is to make sure that you understand that that is a taxable event when it comes to traditional IRAs. The other thing about IRAs that you want to keep in mind is when you're under the age of 59 and a half, if you take out a distribution, the IRS does assess a 10% tax penalty. That is something that you want to be aware of, and that's another reason why you want to speak with a tax professional as far as what to do next. All right, so let's wrap up about traditional IRAs. So earlier I told you about traditional IRAs and the various things about traditional IRAs. So one is a traditional IRA is a pre-tax account. If you need to reduce your taxable income, you typically want to use a traditional IRA to do so. Another thing to remember about traditional IRAs, if you're under the age of 59 and a half and you take a distribution, meaning taking money out of your IRA, you're going to pay a 10% tax penalty to do so. Again, when it comes to contributions, meaning putting money in, the IRS does set a limit as far as how much you can put in to that traditional IRA. A traditional IRA is not something that's offered by your employer. It's something that you participate in separately on your own. Remember, traditional IRAs also, when you take distributions after the age of 59 and a half, all of your distributions are taxed at the federal and state level. That's assuming that your state does offer income taxes. Some states do have no income taxes. So if that's the case, you won't pay any state income taxes, but at a federal level, at a minimum, you'll pay federal taxes on that distribution. Now, I mentioned earlier that there are two types of IRAs. So I touched on the traditional IRA. Now let's move to the Roth IRA. The other type of IRA that you can participate in is a Roth IRA. Now, the Roth IRA is a little bit different than the traditional, which is in the sense that if you participate in the Roth IRA, there are earnings limits that you have to maintain or be under in order to be able to participate. So the IRS does say that if you make way too much money, let's say $500,000 a year in income, you can't participate in a Roth IRA. There are earnings limits on Roth IRAs. What you put into the Roth IRA has zero tax benefit today. So if you put in $5,000 today, then you can't write it off on your taxes. It has zero tax benefit to you today. The benefit of the Roth IRA, however, is the tax-free nature of the distributions that you take. So again, let's assume that you're 20 years old, you put in $5,000 over the next 10 years, right? So you've put in $50,000 into that IRA. Let's assume that $50,000 has grown to $75,000. That $25,000 in growth that you see from your contribution is completely tax-free to you when you go to withdraw it at retirement age. Again, 59.5 still applies for Roth IRAs. So that 59.5 number is something that's always going to apply when it comes to traditional and Roth IRAs. So keep that in the back of your mind, that that's something important to remember. With IRAs, like your 401k plan, you can invest the funds that are inside of your IRA. And so you can invest it in stocks, you can invest it in bonds, you can invest it in mutual funds or ETFs or all sorts of different investments. My recommendation is either seek that out on your own and invest your dollars over time. That's something that that's specific to you, or work with a financial professional that can help you really understand the nuances of that IRA and give you some benefits there. When it comes to traditional IRAs, they're very easy vehicles to work with. The IRS does set contribution limits as far as how much you can put in per tax year. So if you were in tax year 2023, your contribution limit would have been $7,000. That's the maximum amount that you can put in to both the traditional and Roth IRA. Typically, the IRS does do an annual review. And they typically do raise the contribution limits on both Roth and traditional IRAs each and every year. Typically, the raises are about $500 a year with those types of IRAs. Earlier, I mentioned that Roth IRAs have a tax-free nature of growth, but I really didn't go into the weeds as far as what that really means for you in the way of distributions. Here's an example that you can kind of work with when it comes to taking out your contributions at any time for any reason without penalties. So let's assume that you're 18 years old and you put in $5,000 this year. And the next year when you turn 19, you put another $5,000 in, and then you turn 20 and you put another $5,000 in. Guess what? You've contributed $15,000 over the course of 3 years. But then you turn 21 and you say, and life throws you a lemon and you have an emergency pop up and you need $4,000 for some odd reason. You can actually go inside of your Roth IRA, take out that $4,000 of your contribution. Remember, you put in $15,000, so you took out $4,000 out of that 15. That distribution is not taxable to you. You cannot be penalized for it. It's your money that you're taking out. The only time you'll face a penalty is growth of the asset. So if that asset grows for any reason, that's when it becomes taxable or penalized to you. But when it comes to your dollars that you put into that Roth IRA, you can take that out at any time for any reason without any sort of repercussions that you should be able to face on the back end. Let's wrap up about Roth IRAs. So Roth IRAs are a vehicle unlike the traditional IRA in the sense that your contributions that you put into the Roth IRA give you zero tax benefit today. So you can put in money into that Roth IRA today. There's zero tax benefit today. The tax benefit to the Roth IRA is down the road when you go to take distributions out of the Roth IRA. So when you take money out of your Roth IRA after the age of 59 and a half, all of those distributions are completely tax-free to you. both at a federal and state level. So you don't have to worry about ever paying income taxes on that portion. The other benefit to the Roth IRA, as I mentioned, is you can take out your contribution at any time for any reason without any sort of penalties. So keep that up, keep that up your sleeve if and when you need that for any reason. Roth IRAs, like traditional IRAs, have contribution limits. So the IRS does set that contribution limit on an annual basis, and they reevaluate it every single tax year. The other thing to keep in mind about Roth IRAs, like traditional IRAs, is that you can keep those dollars invested within that Roth IRA. You can keep it invested in stocks, bonds, mutual funds, ETFs for any reason, and it works out really well on that end. And the last thing to keep in mind about Roth IRAs is that when you think about a Roth IRA, it's a great vehicle for somebody who is looking for tax-free income down the road. That's really the main reason why a lot of people participate in Roth IRAs. It gives individuals the ability to have tax-free income without any sort of repercussions on the back end when it comes to tax liability or anything like that. So there are times where not everybody goes into the traditional workforce and they work for an employer. Maybe you're an entrepreneur. Maybe you work for yourself. Maybe you're an influencer. Maybe you've figured out a way to generate income for yourself and you started your own business. So there are different types of retirement plans offered to small business owners or somebody who's an individual or an entrepreneur. So you can do certainly a traditional or Roth IRA, but there are also SEP IRAs out there, simple IRAs out there. There are solo Ks out there. There are a lot of different retirement solutions available to self-employed individuals as well. The best thing to do is when you're at that juncture and you're thinking to yourself, what should I do to set myself up for success for the long run? It's probably best that you speak with a financial professional to figure out what's the best solution for you. There are a lot of different resources out there. You can certainly Google it for yourself. You can certainly research it for yourself. But sometimes it's best to get some advice from a professional that can give you a direction and give you some advice on where to go next. Because sometimes it comes down to making the right decision at the outset, which can net the best results for the long run. So I've got clients who have traditional IRAs. I've got clients who have Roth IRAs, but I also have clients who have simple IRAs and SEP IRAs. As you can see, it really comes down to your needs. There's not a one-size-fits-all approach here. It really comes down to your needs, what's specific to you, and what matters to you. And so just because you're not in the workforce for a traditional employer, you might think to yourself, well, I don't have a 401k option available to me. That's not true. You can set aside money in a retirement plan, like a traditional IRA, a Roth IRA, a SEP IRA, a simple IRA, and there's different, certainly, vehicles and vessels to do that within. Thanks for taking the time to listen to me today, talk to you about the importance of saving for retirement and the various types of solutions that are available. We talked today about 401k plans, 403b plans. We talked about individuals who are self-employed and how you can participate in a SEP or a simple IRA when you're self-employed. We also talked about traditional and Roth IRAs. My one piece of feedback to you would be if you're interested in getting more information, certainly seek it out online for yourselves or speak with somebody who's a financial professional who can give you some advice on the back end to make sure you're on the right track.